welcome to your Monday Futures Market Outlook for November 22nd, 2010. This is Patrick Ceresna. For those of you that have not had an opportunity to try out eMiniSource.com, 30-day complimentary memberships are available on the site. As always, we start off with a weekly chart of the S&P 500 going back 3 decades, and when we plot an 80-week moving average on there, does a very good job to depict the bull and bear market cycles the market has gone through. Just over a year ago, we bullishly crossed above that 80-week moving average, and on that last pullback, we actually were able to stay above that 80-week moving average. At this stage, that opens the window for the market to remain bullish into the early part of next year. When we take a closer look at that S&P 500 on the daily charts, what we basically saw was a sell-off that found support right at that 1175, 1180 focal point we've had drawn on for a couple of weeks and subsequently bounced. This area right in here around this 1200 to 1205 area is an actual very critical moment in the market, because if in fact we can get above that area, it would immediately open the window for not only a retest of the previous high right up here in this 1215, 1225 area, but it would also open the window for potentially a rally as high as the 1240 to 1250 area. And even in the bigger picture, there's some even higher targets than that we could look at. But in the same regard, if we reject it at this stage, right off of this point, then this would have been sort of the little blip up in a zigzag formation that would continue to develop a consolidation flag like this on the downside. So if we see the selling Monday and Tuesday come in here with any follow through, then it would open the window for us to even get down as deep as the 1150 area on the downside. That, of course, in the end, I still believe would end up becoming bullish as the market would roll up from that. But nonetheless, in the short term, it would mean that a lot of positions would continue to feel a lot of pressure. Just to review our key points, we are now intermediate bullish on our stance. In the bigger picture, I still believe that we're in a big secular bear market, but we are right now in an up phase of that market on intermediate period. There is short-term risk of that profit taking, but we still actually believe the market at the end will advance higher. Again, we're watching that 1205 level as a pivot for that next significant move. And if we fail to break above that 1205 area, then we should see an S&P trade down toward the 1150. I mean, we might see a low 1155 or 1160. I'm not necessarily saying 1150 has to be hit, but we would definitely see a move gravitating down toward that level. Long-term investors could buy, but would need to stomach that potentially deeper profit-taking cycle. But again, that will probably emerge to being a buying opportunity. Next year, I'm going to take a look at that NASDAQ 100, and we're literally in the same boat as the S&P. Literally, what I drew out on the S&P would be identical for the NASDAQ. Anything that starts breaking above this 2150 area would have the NASDAQ retest the highs or go gun for that 2250 area on the upside. But realistically, if we roll off of this point, we should see about the 2050 level on the downside before the NASDAQ really has a good basing and roll up on the market. Now, when we take a look at that U.S. dollar index, this is primarily one of the reasons why the market has gone through this consolidation is the rally we've seen in that U.S. dollar. Now, we had a pop up toward about the 79.50 area and then rolled back down. But if the dollar index rolls and turns bullish here, especially a break above that 79.50 area, it would immediately open the window for the dollar index to gun for the 80.50 area on the upside. That's the home of the retracement zone, as well as where the lows came in back in August. And so that would be an area where the dollar should find some overhead resistance on the initial targets. Now, it'll be very interesting to see whether or not that these are the areas where the dollar fails to continue to rally beyond this 79.80 area on the upside. If this is all where the dollar index over the next week or two is contained to on all upside pushes, eventually the dollar will roll over again and start another leg lower, which would be very bullish for the market. And so we're going to be watching whether or not the U.S. dollar is losing steam here in these zones up above. Now, that doesn't mean on the short term we can't get a push up to there. just is about the way it's going to behave in these zones. And if for whatever reason, if the dollar index became very bullish, we could theoretically see a test of the 83 to 83.50 area all the way on the upside there, a much bigger, fuller retracement on the much bigger picture move on a weekly scale. If we saw that, then the market will probably stay very range bound, if not a week over the next little while. But at this stage, we're not anticipating that. When you take a look at gold, gold has finally sold off down toward the support line around that 1320, 1330 area where all those lows came in. Depending on what the next wave of the US dollar is, we could see gold test down toward that 1300 or even as low as 1250 to 1260. We believe that gold should go through about a 1 month or a multi-month consolidation. In fact, we may have probably seen the year high in gold. That doesn't mean that we wouldn't be bullish going into next year at some stage. We just simply believe that this leg of gold is over, and we needed to see one of those kind of multi-month consolidation points from which gold can rebase to start another major leg of a move up. When we take a look at crude oil, we had a very, very aggressive sell-off in crude that made it all the way down to the 79.80 zone on the downside. That's a pretty significant sell-off and a pretty significant reversal. That immediately sends a warning sign that that 88 price point that was hit a couple of weeks ago will probably be the year high in oil. Now, that doesn't mean oil can't rally towards 84 or 85 on the upside, but more than likely we will probably see another retest of this 80 zone, or maybe even as low as that 77, 78 zone marked off with the blue box. And those are all kind of areas where oil will probably be consolidating into the upcoming weeks. Finally, I want to take a look at the 10-year Treasury notes. And one thing that we're noting here is that the 30-year Treasury, the longer end yield curve, has already put in a top back in September and really started making very significant breakdowns. Now we see that 10-year continue to not only break down the way it did, but fail to rally and undo the damage that was done in that last move. Now, on any short-term period, we could see one or two handles higher on the Treasury notes, but that won't change this kind of a reversal pattern and almost like equivalent of a double top that occurred up in the 27.5, 28, so 127.5, 128 zone on the upside. And if we any rally attempts here that fail may very well emerge to being a new shorting opportunity on those 10-year Treasury notes. That was your Monday Futures Market Outlook. Thank you for joining me.